Hi there, Evan here with Crypto and Markets for Monday, May 7th, 2018. Going to be covering emerging markets and secondarily emerging market currencies. As we all know, the emerging markets, along with the rest of the global economy, peaked out roughly in about August of last year. Of course, we see that European manufacturing PMIs, Chinese credit cycle, Korean exports, US industrial production, you name it. Then, of course, managed money didn't see this, kept piling into the emerging market currencies, piling money into emerging market stocks, not seeing what was going on, using it as a proxy in the short volatility complex, which we, as we all know, short the dollar, short the VIX, long the euro, long commodities. Now, what do we know? One, the emerging market stocks, the emerging market currencies, from this all peaked out roughly in about January, right after the stock market peak, have been going lower ever since. Two things to keep an eye on here. One, emerging markets have a lot of debt denominated in US dollars, which means the cost of financing is going to get a lot more expensive for them. Now, what does that mean in reality? Of course, the cost of, with anything with a growing economy, the cost of upgrading your infrastructure, the cost of building bridges and roads, the cost of building real estate, the cost to build out commercial. A lot of this, of course, is financed with debt, and debt being in US dollars means it's going to cost roughly between 15 and 20% more in local currency terms, which then going to lead a pair back to a lot of the spending, which is then going to be part of the emerging market slowdown that is starting to happen this year. Second area, and this is an area no one's looking at, the consumer. Remember, what the emerging markets rely on for industrial growth, for infrastructure growth, whatnot, but also for growth in the middle class as well, they rely on a weak US dollar to allow their citizens to buy goods. Now, as the US dollar starts going up against these currencies, the cost of the paper that they hold is now worth a lot less. And again, remember, we're not talking middle class of developed markets. We're talking middle class in developing / emerging markets, where a decline in the value of their money would mean a lot more than it would in a developed market. Because middle class incomes, of course, are a lot less. That dollar, of course, has to go a lot further. And now the value of their money going down, it's going to also put a hamper on the consumer, which is going to be the other area that's going to lead to the emerging market slowdown. One thing I should bring up here, because of my last point, this is one thing the bulls relied on at the beginning of the year to get the oil price higher. Like, forget the geopolitics, forget what I think. Geopolitics driving the price up after the stock market's peaked. And then 3 to 6 months later, the demand declines start coming in from a slowing economy, driving the price of oil down. You all know that. I have a previous video where I explain all this. I'll link it down below. But remember, as far as oil demand goes from the emerging markets, like, here's a good example. India. For India, they had 8 to 10% demand growth priced in for this year. The Indian rupee is down roughly about 6% on the year. Likely to keep going lower. I have it going roughly about another 10% lower from here. Which means the value of the rupee is now 15% lower against the US dollar, which is what oil is priced in, than it was at the beginning of the year. Same thing here as the rest of the emerging markets. That money's not going to go as far. Consumers are ultimately going to have to pare back. And remember, in a lot of these countries, it's not like developed markets. Driving is a big luxury there, right? So an increase in the cost of gasoline will hurt them a lot more than it would in a developed market. Like if you get the middle class having an average income not nearly as much as a developed market, etc. But even a 5% decline in the rupee will lead to some demand declines. And even if you only, let's say, still get growth, but get 6 to 8%, and get 4 to 6 from the rest of the emerging markets instead of 6 to 8. For what they got priced in right now, not good enough. So to go ahead and put it in closing, watch the emerging market currencies. With the stock market bulls, the commodity bulls, relying on these economies, relying on these currencies to keep the market up, as they keep going lower, this, while being a proxy for that short volatility complex, will drive the markets much lower. Hit the like button, leave a comment down below, subscribe, and follow me on Twitter @CryptoMarkets2. Have a wonderful day, everybody.